Welcome to Ausbil's post-earnings season 2016 seminar or session. This is a first for us and inaugural.
Great to be here and looking forward to some good questions during the course of our discussion today.
Well, for me, it's always a privilege to get in front of companies and speak to the chief executives and find out their strategy. And the benefit of that is not just the numbers, but understanding the depth of the numbers.
This earnings season is probably the most important earnings season we've seen since 2010.
Open up to questions now. We have a few members of the audience who've actually pre-submitted some questions, so I'd like to start with a couple of those.
When we look at our market cap compared to GDP, it's around 90%, which doesn't seem so overpriced. I mean, what's your view on our current valuations?
We have seen expectations being slightly revised up over the past 3 or 4 months to be slightly higher than where it was some few months ago. And what's driving that has been something where the market had very, very low expectations, was earnings growth coming from the resources sector. Now, that's been driven by 2 factors. One is that we have seen significant cost out by that sector, but also we have seen commodity prices being higher than what the market was expecting some 12 months ago, even 6 months ago, and even 3 months ago. Our view is that 2017 should be a broadening of earnings, which will be different to that of 16. And we do believe that if commodity prices do hold current levels, which is still above expectations, we could see some further significant earnings upgrades over the coming months, which will be largely driven by resources. And that in itself is quite interesting, and certainly something that you wouldn't have thought was quite possible, given that commodity prices last year had such a large fall, and the outlook for global growth is such where we're not expecting a significant upgrade in growth. We have seen very large producers, the likes of BHP, Rio, Fortescue, Vale, actually reduce costs quite dramatically, to the extent where Fortescue in today's market, with the commodity price, well, iron ore being at $55 to $60, they're making more money now than they were when the iron ore price was $160 to $165. So that's how significant they've reduced costs. Likewise with BHP, likewise with Rio. And the catch cry that these mining companies are using now, and this is their mantra, is that, and this is really led by Fortescue very early, is that they're managing the business for value, not for volume.
There's been a massive cost out focus by just about every company you can possibly imagine, and that really accelerated through reporting season. The one that comes to mind in particular has been South32, the spin-off from BHP, where after they came out of BHP, they said that business is okay and we could probably take out $350 million worth of cost, which was under 3% of their cost base over 3 years. In the August reporting period, they announced $386 million have been taken out in the first year. So a huge win for shareholders.
I've just got a query on the sustainability of banks' dividends going forward.
23 of the last 25 years, banks have actually outperformed the market. It's only been the last 18 months or thereabouts that they've actually gone through a period of underperformance. There's been a lot of reasons for that. One being, very much the what the banks require from a capital perspective to be unquestionably strong. That still hasn't been fully defined as yet by the authorities, but we are getting close. The other factor which has been influencing banks clearly has been modest top line growth, where we haven't seen too much loan growth overall. And we've also seen net interest margins being under a little bit of pressure. And coupled with the fact that we've just gone through multi-years of benign bad and doubtful debt cycle, and we're at a pretty low point, so the expectations is for that to pick up. We ask the banks on a regular basis, and in fact every time we see them, about the sustainability of dividends. And in fact, I had the chairman of Westpac in yesterday and asked him that very question as well. Can you sustain the bank's dividends going forward? That's something, I think that from an executive point of view and from a board perspective, they would like to very much sustain the dividend, but they will have to adjust if things actually deteriorate, but that's not our base case. So I think that you can take a bit of comfort in suggesting that a lot of it's already priced in. I think that banks at these levels look reasonably attractive, and certainly they could actually benefit from some of the rotation which we think is likely to occur as we see some of the high yields, I mean the interest bond proxies rather, being highly valued and coming back into the banks as time goes on, because I think yield is still very valid.
The other observations that I've had, and I jotted a few down as I was going through reporting season, is not only is the cost out theme, but a lot of businesses are repositioning themselves in a low growth environment. So you're not getting much earnings growth, not much top line growth, so what do? Yes, cost out, but you also reposition. And of note, and the biggest one has been Woolies, right? So they're chopping out of Masters, they've just sold Home Timber and Hardware to Metcash, so they're benefiting from a repositioning. Ansell would be another great example where they've said, right, we've got two parts of our business. One's the sexual wellness through Ansell, sexual wellness business. They're selling that and repositioning into industrial gloves. Ardent Leisure, which is also in our Emerging Leaders Fund, it's selling its marinas business, selling its gyms business and repositioning for growth into the US. So I'm prepared to pay a higher multiple for that type of potential growth. There's some examples on the business repositioning. And the other one is acquisitions. So the market will start to pay up a little bit more for those companies that are making strategic acquisitions that can really add value and then have that potential earnings upgrade. So you're prepared to pay a little bit up front for that earnings upgrades. In fact, retail had a great earnings season. Like-for-like sales are really picking up. You've got low unemployment, you've got house prices going up and very low interest rates. So there's confidence out there in consumer land. And I actually think we're going to have a reasonably good Christmas. JB Hi-Fi had nearly 10% like-for-like sales growth. We got in front of Richard Murray, the CEO, and he said, no matter which way you structure the Good Guys acquisition, it's going to be accretive to your business. But do you really want that business? And his emphatic answer was, yes, we absolutely want it. So they announced this week they're going to buy it. They just had a rights issue. So JB Hi-Fi is in our Emerging Leader Fund. We're participating in that rights issue. The stock's up 7 or 8% today and performing well. And I think there's earnings upgrades as it really consolidates that appliance business.
Top line revenue growth, as you asked, hasn't been prevalent in the marketplace for quite some time, really. But throughout August, we did see decent top line revenue growth coming through that healthcare sector. Certainly, Ramsay, CSL, and Cochlear delivered double-digit top line revenue growth. The standout was Cochlear at around 22% revenue growth. Then you look at the paper packaging sector. Again, ORA and Amcor delivered 13 to 14% top line revenue growth. And some of the domestic cyclicals related to the housing activity have delivered good revenue growth as well. CSR 13%. Fletcher Building, which gave one of the most outstanding results in August, had at least 4.5% top line revenue growth. So we are seeing it, but the dominating sector has been healthcare. In fact, CSL and Cochlear have delivered great top-line revenue growth for 5 years. But if you take a step back, and what's really happened is that for the last 6 years, we've seen over $14 trillion worth of quantitative easing in the marketplace. We've seen 600 interest rate cuts globally in the marketplace. And we've got 40% of the world bond market negatively yielding. So that's driven those bond proxies and driven some of the top-line revenue growth, particularly in the infrastructure space in Transurban and Sydney over the course of the last 5 years. And what's different now than what it was 5 years ago is that the US bond, 10-year bond, got as low as 135. 5 years ago, it was at 5%. It's the same in the Australian market. 5 years ago, the Aussie 10-year was at 6%. It's now down to 2%. So the quantitative easing is exhausted, and these stocks are at extreme levels, and that's why we do think we are at an inflection point, and that's why this reporting season is of paramount importance.
Just wondering what your guys' view is with Ausbil in regards to ethical investing. Do you take it into account in your traditional funds, or do you think it's better off sitting in a specialised ethical fund?
No, we're very committed to ESG investing. I mean, we've integrated that into our mainstay funds. We have an ESG unit internally. But what we do at Ausbil is that we have a group of financial analysts which work very closely with our ESG team, and we do combine and coordinate our recommendations accordingly. We see ESG as a good lead indicator for opportunity and also to identify risk levels as well, or risk that may be occurring going forward. So we think it's a good process to incorporate.
close it off, each of you give a little bit of colour.
Well, for me, it's always a privilege to get in front of companies and speak to the chief executives and find out their strategy. And the benefit of that is not just the numbers, but understanding the depth of the numbers, but also reading the individual and seeing their levels of confidence, what they're really going to hit in terms of earnings prospects and earnings forecasts.
We are at an inflection point, but there are strong companies delivering very, very good free cash flow, delivering multi-decade EPS underlying earnings, and particularly in that healthcare space. And it's really quite impressive what Ramsay has delivered, not only through this reporting season, but for the last 10 reporting seasons. And here's a company for the last 10 years have delivered good top-line revenue growth. And in these times of volatility and where the market has rallied very aggressively since March 6, 2009, you can take comfort in a lot of these healthcare companies that keep on delivering on their earnings. And I like boring companies that keep on delivering on their earnings and growing their profile. So I think I took a lot of comfort out of that space.
For me, the reporting season, it really is a report card by the company. So, you get to see what it delivered and also the quality of its earnings, and also if there's any, funnies in there in the sense of its quality of earnings. So, cash conversion is something that we really look at very, very strongly at that time. I mean, during the confessional period, companies may announce some earnings upgrades or downgrades relative to market, and the market will react. But then at the report, when they do report, you can sit down and actually go through in a fair bit of detail and understand, what actually drove that and drove that quite strongly. A good example of that would be BlueScope Steel, where it upgraded 3 times this year before it reported. And again, the stock rallied before the report, and then on the day it reported, it actually rallied quite strongly as well. And the reason for that, because the quality of its earnings were actually far superior to what the market was expecting. The market had the quantum out there, but they didn't understand the quality of the earnings and where that earnings was coming from. Also the cash conversion and also the sensitivity of their forecast going forward and what it means for future earnings. So that's what you get out of reporting season, and for us to get in front of companies analysing, questioning and them in a fair bit of detail is, as John said, it's a privilege.